Okay, ladies and gentlemen, it is now 12:02. We're going to go ahead and get started. Good afternoon, everybody. Happy New Year 2023, and welcome to the next installment of Michigan First Virtual Series on Credit Awareness. My name is Jeff Fitrzyk, Chief Lending Officer for the Credit Union, and we're excited to have all of you on for this important event. Those of you that have been members of ours for a number of years have likely attended one of our credit awareness in-person seminars, which we hold typically 2 times a year. In those events, in the span of about 2 to 3 hours, we take a deep dive into what makes up a credit score and how to effectively manage your credit to ensure that when you need to borrow, you have the best chance to get the best rate that you can. This installment's not going to be that long, but it is the next installment in our quarterly webinar series on credit awareness and management, and it will provide information on the importance of maintaining credit capacity and what you can do to maximize it after a season of spending, just like I'm sure all of you did during the holidays. As always, we're very fortunate to have the person that I consider to be the expert in this field, in this area of the country, and that is our underwriting manager, Mr. Noel. He's been with the credit union for about 15 years. He's worked in the credit and financial services industry for 20 plus years. And he educates not only our team, but many of our members on how to best manage through credit and financial challenges to ensure that the cost of borrowing for everybody remains affordable long-term. A couple of quick things before we get started. The chat feature within the presentations platform will be your opportunity to present questions to us, as no real-time audible questions will be taken. We have everyone muted and videos disabled. Please direct messages to Jamie Baker or myself. Again, I'm Jeff Fitrzyk, with questions that you wish to have addressed near the end of the session. The information presented today should last approximately 40 minutes, and then we'll take some time to review and answer some of the questions that you've presented. And we intend on ending no later than 1 o'clock today. So without further ado, I'll hand the presentation over to Brock to begin. Thank you, Brock.
Thanks, Jeff. And thanks for making me feel old by saying how long I've been in the industry. I appreciate that. Welcome, everybody.
You're still younger than I am, Brock.
Welcome, everybody. Want to say thank you very much for spending some time with us today. I know everybody's busy, and we want to thank you very much for spending a little bit of time with us. These seminars that we do are extremely important. We usually give them once a year. These virtual seminars have allowed us to do it more frequently, and that's great because we can talk about these things more, talk about credit more, and educate everybody more on credit, because let's be honest, credit wasn't something that we were ever taught in school. I know that there's a lot of bills out there that are trying to be passed to teach some of this stuff to high schoolers, and I think that's really important. For those of us who've been dealing with credit and bills for a very long time, we didn't have the pleasure of learning this in high school. I don't know when the last time any of you have used algebra is, but I haven't used any of that in a really long time. But I do use credit a lot and think about my credit a lot and what it can do for me. So these are extremely important, and we're happy that you're here with us today. What we want to focus on with this seminar is, what do you do after the holidays? Traditionally, this time of the year in January and February, what we've seen here at Michigan First is our members' credit tends to go down a little bit after the holidays. And today we want to talk about why does that happen? And more importantly, what can we do to combat that and get our scores higher? And one thing that we want to focus on today, and it's something that we've talked about in just about every seminar that we've done, but bang for your buck, this is the most important thing to talk about when it comes to credit. Most of us know that if you don't pay your bills on time, your credit score will go down. That's something that's kind of ingrained in all of us, and we know that. But what a lot of members don't realize, a lot of consumers don't realize, is that credit capacity plays almost the biggest part as how well you pay your bills. Yet a lot of members that I talk to don't know what credit capacity is, or they loosely know what it is, but they don't know how to make it better to help their credit score or how it affects their credit score. But credit capacity is the fastest way to get a credit score increase. When you don't pay your bills, which is something that we're not going to dig too deep into today, it takes a while to get back from that. Your credit score will suffer for a longer period of time. Whereas credit capacity, if you fix that and you can fix it quickly, the next month your score could go up, and it could go up significantly. It could go up as much as 100 points in just 1 month. So that's why this is important to talk about. That's why we're going to focus on it today in relation to what happens during the holidays. Let's talk about what credit capacity is first, though, so we can understand what that is before we talk about how to get your score higher using it. There are certain loans that affect your credit capacity. Those would be revolving loans. Revolving loans are your credit cards and your unsecured lines of credit. These are types of loans that have credit limits on them. So you could go out and spend money, you could pay it back, and then you can reuse it again. That's what we talk about when we're thinking of revolving loans. Mostly credit cards. That's the most popular type of revolving loan that our members have. In a definition, like if we look this up in the Webster's dictionary, a definition of credit capacity is the ratio of combined revolving credit balances in relation to combined credit limits, or the percentage of revolving credit available. Now that, and not used, that sounds like a whole bunch of words put together that don't make a lot of sense to me. If you want to think about it in layman's terms, all of your credit cards and personal lines of credit have credit limits. If you added all of those up together, how much of that are you using? So if you put that all into $1 amount, how much of that capacity are you using? Or how much of those limits are you using? That's what your credit capacity is. So if you added up all your credit cards and they added up to $50,000 worth of limits, how much of that $50,000 are you using as a percentage? That's your credit capacity. So let's talk about how we can calculate credit capacity in an easy manner. I like to use even numbers here to make it easy for myself. So let's say you added up all your credit card limits and you have $10,000 that you can go spend. And let's say right now, today, you're using $4,000 of that $10,000. How you calculate capacity is you subtract your balances from your credit limits. So in this example, you subtract $4,000 from $10,000 and you get $6,000. That's how much you could go use still. So you take that $6,000 and divide it back by your credit limit of $10,000, and that's your capacity, 60%. So you can go use 60% more of your available credit is basically what that's stating. That's all fine and dandy. You say, Brock, why does this matter to me? Well, this is a very powerful tool that you can use to increase your credit score, because for every percentage point you gain in your capacity, it almost equals a point on your credit score. So I'll say that again, for every percentage point you gain in capacity, you gain about a point on your credit score. So let's say you're maxed out on all your credit cards. You have zero capacity. You don't have any. That's driving your credit score way down. So if you went out and paid all that credit card debt off, all of a sudden your capacity goes up to 100%. You could gain about 100 points on your credit score. That's huge. That could take you from a D or an E tier up to an A or A plus tier. And when we're talking about what interest rate you would get on loans, it's a huge difference. And that would just be money in your pocket saved. That's why we talk about this. That's how powerful credit capacity is. So if you are maxed out on your credit cards right now, or you're getting close, you have a great opportunity to boost your credit score by boosting your capacity higher. Now, there is an inverse to that too. Why did my credit score go down after the holidays? Well, let's think about it. What do many people do when they go out and they buy their Christmas presents or their holiday presents? You go out and you spend it on your credit cards. A lot of us do. I know I do. Go out and spend it on your credit cards, and then you worry about paying it down. Okay, it's the holiday credit hangover. Well, if you go out and you spend a lot of money on your credit cards, your capacity is going down. When your capacity goes down, your credit score goes down. So typically those first few months after the holidays, when people are still trying to figure out how they're going to pay off the money that they spent, your credit score is going to suffer. If you don't do anything about it, it can suffer prolonged into the year. If you do something about it, which we'll talk about some strategies to use, you can boost your score up as immediately as next month. Okay, so that's why scores go down after the holidays, because a lot of consumers use their credit cards during the holidays, whether it's for presents, whether you go on a trip, what have you. Lots of spending happens in the months of November and December. And sometimes as consumers, we pay for it when the new year comes around. Literally, we pay for it. So how can we gain some capacity? How can we make our scores go higher? Well, you could open a credit card with Michigan First. That would certainly help. And what I mean by that is sometimes members I've talked to don't like credit cards. They say, I don't want to have credit cards because I don't want to spend the money. And sometimes members just have a little bit in their credit card portfolio. So they might have a couple small credit cards. Well, if you can open up a credit card and have a sizable balance on it, that'll help your capacity, because you could go from not having any credit cards where your capacity is automatically going to be zero to just going out and opening a card, even if it's a smaller card. And if you don't use it, your capacity is 100%. So if you don't have any credit cards right now, come to Michigan First. We'll see if we can get you ours, and that'll help boost up your credit score. You can pay down your revolving debt as well. Now, I know we live in the real world. There's not very many of us that every month can just go pay off our credit cards, especially if we have large balances. But any amount helps paying it down, because when you pay it down, even if it's half of it, you're still increasing your capacity. So if you can't pay it all down, pay some of it down if you can do that on your own. Another thing you could do is raise your revolving limits. So let's say in a real world example, you have a $5,000 credit card and that's all you have, and you're maxed out on that right now. Your capacity is going to be zero, so you're driving your score down. If you called that company that you have your credit card with and asked for a credit increase and they raised your limit up to 10,000, all of a sudden your capacity went from 0 to 50% only by increasing your credit limit. You didn't have to pay anything down, because you went from having nothing available to having half of your card available. So you could increase your score there by almost 50 points, and all you did was call and ask for a credit increase. So that's an option for you as well. You could do both of those options and it would help even more. So if you can't pay all of your balances off, pay down as much as you can and call and see if you can get increases on your cards. One important thing to do as well, and I'll preface this by saying everyone should be getting at least once a year a free copy of the credit report. That will help you keep an eye on things. Some things may pop up that you don't know about, but it can also help you look at things and make sure everything's reporting correctly. There are some companies out there, we're not included in this, but there are some companies out there that will report your home equity lines of credit as a revolving line of credit instead of a mortgage on your credit report. There's different designations that financial institutions send to the credit bureaus. If you have a mortgage or a home equity line of credit, they should be sending it to the credit bureaus as a mortgage, not a revolving line. So this could get you into trouble if you have a home equity line of credit and the company that you have that loan with is reporting it as a revolving line instead of a mortgage. Because think about it, if you open up a revolving line of credit to do some repairs around the house, you're going to be using that money. And as you're using that money and as your balance is increasing on that home equity line of credit, if it's reporting as a revolving line, that's going to drive your score down. Whereas if it reported as a mortgage, it would help your credit score, especially if you were paying it on time. So make sure that your HELOCs are reporting as mortgages. There are also some companies out there, some credit card companies that will not report your limits to the credit bureaus. So if you had a $10,000 limit on a card and you were using 8,000 of it, if they didn't report that credit limit, it would show that you're automatically maxed out on your card, even though you weren't. So it's also important to get that copy of your credit report to make sure that your limits are all reporting. You want to get credit for all of your limits out there because you want to help that capacity go up as high as possible. And one thing I want to spend some time talking about is applying for a debt consolidation loan, especially if you did it with us at Michigan First, because we can certainly help you out with that. Debt consolidation loans can be a powerful tool for you to use to pay off your credit card debt, okay? So when we're talking about a debt consolidation loan, you can get a quick capacity rebound. And the reason for that is A debt consolidation loan is an installment loan. Installment loans are different than revolving loans like credit cards because you have a certain amount of time to pay installment loans off. And when you're done paying those, your hands are wiped clean. The loan's over. So a car loan is a great example of an installment loan. If you take out a car loan, you have a certain term to pay that off, 5, 6, 7 years. And once you're done with that, you're done. I mean, you get to keep the car. But for a debt consolidation loan, it's the same thing. It's an installment loan. So you would take out a loan to pay off your credit card balances. You're not taking out any more debt. All you're doing is you're shifting your credit card debt to installment debt. So what does that do for you? Well, it frees up all your credit cards. Your limits are all going to be open. So you take your capacity up to 100% if you can pay them all off, and your score can go up significantly. And all you did was restructure your debt. You took it from revolving debt and placed it into a personal loan. That's an installment debt. Okay, so that's a quick way to get a capacity increase as well. The other nice thing about a debt consolidation loan is you have an end date in sight. There's light at the end of the tunnel. You know, if I'm taking out this debt, this is when I'm going to pay it off. And that can be comforting to a lot of people because if you just pay your minimum payments on your credit cards, you will never pay them off. And I'm not exaggerating. If you look at your credit card statement, they should have this in there for you. If you pay your minimum payment off, it will show you the end, or if you only pay your minimum payment, it'll show you when the date is to pay it off. And let me tell you, it's beyond your lifetime. Most of your payment, when a minimum payment's made on a credit card, goes to the interest of that credit card. So having an end date in sight with an installment loan at least lets you know when you're going to pay that debt off. Now, if you take out a debt consolidation loan, it's crucial to be patient. And you don't want to charge those balances back up. You don't want to compound the problem. If you take out a debt consolidation loan and then you just charge your balances back up, you're hurting yourself on two fronts. You've just doubled your debt and you've just ruined your capacity advantage again. Your capacity that went all the way up after you pay that debt down is going to come all the way down, and it can hurt your credit score. So you have to be disciplined if you take out a debt consolidation loan. Know when you're going to pay that loan off and try to keep your credit card balances down as much as possible. When you do a debt consolidation loan, the shorter term that you can take that loan out on, the better for you. Not only will you have the debt paid off faster, which is the goal, but you'll save yourself a lot of money in interest that you pay. If you string a loan along for many years, you're going to end up paying more interest on that loan. And we're going to look at an example of that in just a couple slides. But the shorter term you can do, the better it is for your wallet. So keep that in mind if you're going to do a debt consolidation loan. So if you pay more than your minimum payment on your credit cards, a debt consolidation loan probably makes sense for you. I know a lot of us out there try to pay more than that minimum payment. And sometimes it still feels like we're not paying that balance down very fast on our credit cards. But if you did a debt consolidation loan and you still paid the amount that you were paying towards your credit cards, you're probably going to pay it off a lot faster. So if you are paying more than your minimum payments, this is a great option for you to pay your debt down and to increase your capacity. A lot of times when you do a debt consolidation loan, if you're only paying your minimum payments on your credit cards, your monthly payment might go up. And that's because when we talked about those minimum payments on your credit card, they can keep those low because you're not paying that down. When you move it into an installment loan, your payment is probably going to go up from what your minimum payments are on your credit cards. But that can be a good thing for you, okay? Because you're paying that loan off instead of just stringing the balances along with no end goal in sight. So let's look at an example of a debt consolidation loan and look at two scenarios with the same situation. Let's say you spent $10,000 during the holidays. Someone had a great holiday if that's the case. And if you can adopt me into your family next year, if you're going to spend that much again, I would highly appreciate it. But $10,000, you spent that during the holidays. Let's look at a loan number one example. Your balance is going to be $10,000. Let's say you take that out for 60 months. That's a 5-year term. With the interest rate of 14.99%, your monthly payment is going to be about $238. It's pretty affordable for $10,000. But look at that interest that you pay if you string it out for that long. You're going to pay almost $4,300 in interest. So that $10,000 is end up really going to cost you a little over $14,000 when you factor in that interest. So if we shorten up that term, let's look at the other example, loan number 2. It's the same balance, $10,000, but it's a much shorter term, 24 months, so 2 years. So we're shaving 3 years off of that original loan. Interest rate's going to be the same, 14.99%. Your payment goes up. Look at that payment difference. You're talking about $484. But remember, you're paying the loan off 3 years quicker. But look at the difference in the interest that you pay between these two loans. $1,600 is how much interest you would pay on a 2-year loan in this example. So that $10,000 cost you about $11,600 as opposed to over $14,000. That's a lot of money to save over a 3-month period of time. So the payment difference is a little less than $250. So you have to know that going in. However, you can save over $2,600 in interest by doing it that way. So you have to decide what's more important to you. Do you want the monthly lower payments where you're stringing your debt along, or do you want to get this paid off and save yourself some interest and you want to get paid off quickly? That's up to you to decide. Only you can decide what's more important to you. I can tell you if that you are actively paying more than your minimum payments on your credit cards, it makes sense to do a debt consolidation loan like this. And it makes sense to do a shorter term. You would just take how much am I paying over my minimum payments and compute that over to a payment on an installment loan and figure out what the term is. And we can do that for you. That's what we're here to do at Michigan First. So whether you call in and talk to our representative over the phone, or you want to visit us in a branch, we're going to sit down and talk to you and walk through all of this step by step. So you don't have to figure this all out on your own if you don't want to. We're here to help you. So come on in, call us. We'll walk you through all of this and give you your options. You could look at a 1-year term on a loan like this. You could go 3 years, 4 years. You could look at them all together and see what the difference is. We're willing to spend the time with you to show you what makes more sense for your situation. All right, so let's look at 2023 as a whole. This could end up being a great year for you as far as your credit score goes. So if this year you're looking to buy a car, if this year you're looking to buy a house, buy a boat, buy an RV, any big ticket purchase that you may buy this year, if you're doing a loan for that, there's going to be an interest rate attached to it. The higher you can get your credit score, the lower your interest rate is going to be on those loans. The lower your interest rate is going to be on those loans, the more money you're going to have in your pockets. And let's be honest with each other. It's tough right now. Groceries are expensive. Gas is expensive. Everything's expensive. I have 2 kids under the age of 12. Wow, they're extremely expensive. So any amount of money that I can save and that I can put in my pocket is crucial right now. So 2023, how can we do that? Well, there's some things going on behind the scenes right now that are helping us as consumers, and they have to do with medical collections and how they report to the credit bureaus. The first change that came is already started. This happened last July. As of July 1st of last year, the time before medical collections can appear on your credit report increased from 6 months up to 12 months. That's important for you because when you get notice of a medical collection, instead of trying to figure it out in 6 months, you have 12 months to figure it out. Whether you're fighting that and it takes all that 12 months, or whether you look at it and say, okay, that's my bill. How in 12 months can I figure out how to pay that? And this could be part of your debt consolidation loan as well. So you have more time now to figure that out. And that's big. They doubled the amount of time you have to figure those out. Also, and this is huge for your credit score, paid medical collections don't show up on your credit report anymore. The way that it used to work is if you had a medical collection, it was certainly affecting your credit score in a negative way. Any collection that you have on your credit report really sinks your score. So when you pay a medical collection, it doesn't just rebound the next month. It would still have affected your score month by month, just less and less as time went on. So the month after you paid it, your score would still be hit substantially, even the month after that and the month after that. But as time went on, it would start affecting your score less than it did. Well, that's gone now. If you pay it, it's off your credit report. Your score could immediately boost up from that now. That's very important for your credit score. And it's a huge win for us as consumers. The other thing that's going to happen, and this is going to start in a couple months in March, medical collections under 500 aren't going to show up on the credit bureaus either. That's a huge win for us as consumers, because my 15 years here at Michigan First, medical collections have become an increased problem year by year by year. Whereas when I started at the credit union, I didn't see too many of them. But every year that's gone on since then, it just seems like they're a hindrance more and more to our members. But most of them that I see are less than $500. And the amount of your collection doesn't matter to the credit bureaus. A collection is a collection. It's going to affect your score the same way. So that little rinky-dink $100 collection that you have from a hospital can sink your score just as much as $1,000 collection from a hospital. And I've seen that over and over and over again throughout the years. Well, starting in March, those aren't going to show up anymore. So you could do nothing this year. And if you have medical collections, you may see a boost in your score just from that. So this could be a big year for you and your credit score. Now, if we combine that with what we just talked about as far as increasing your capacity, your score could shoot up exponentially this year. And that's what we're hoping for. And that's what we want to help you with. So think about that debt consolidation option that we talked about. It's a great way, if you don't have the ability to just go out and pay all of your credit cards off, which very few of us do, it's a great way to boost your score. You could add that Michigan First Experience credit card. I'm going to do another shameless plug. It's a great card. You can add that, and that'll boost your capacity by adding more credit limits to your credit report. Paying your balances down, however you need to do it, whether it's all these options that we talked about, however you can do that, get that revolving debt down. There's other things that are helping us as consumers right now. If you can combine that with helping your capacity, you could really make this a big year. And that car that you go out and buy, you can get the best rate available if you can get your score up there, as opposed to paying too much for a car. And cars are already expensive enough right now. Everything is. But you don't want to pay more than you need to. And some of this stuff is fixable. And if you let us help you with that, it will certainly pay dividends for you when it comes to money in your wallet. All right, so that was a presentation. Obviously want to open this up for questions. I hope that was very helpful for you. We're always available too. If you think of things after this and you want to call us, if you want to reach out, we can always try to help you with your particular situation, because I know everybody's situations are different. Everybody's circumstances are a little bit different. We can always personalize that to you. That's what we thrive on here at Michigan First, is personalizing our options just for you in particular, to try to help you out. So without further ado, I'm going to hand it over to Jeff and Jamie to see if we have any questions that maybe come up, and we can help you with that.
Yeah, thank you, Brock. Well done. A lot of good info there. We have a number of questions. I've got a few that I'll present to you, and then a couple that I'll take care of when you're all done. But the first one I've got is, how does the installment consolidation loan by itself affect my credit score? So I guess the question is, if somebody takes out an installment loan to pay off existing credit card debt, we know what capacity does to your score, but what can that installment loan do to my score as well?
The installment loan, when you have a new loan that shows up on your credit report, it can dip your score a little bit just because you took on more debt. But that's minuscule on your credit score compared to the damage that you do by having your credit cards maxed out. So you can still see an increase on your score. And when you take out a new installment loan, that might affect your score for a month or two tops. And then you're going to just see it go up and up and up. But that capacity rebound that you can get from taking that debt from a credit card into an installment loan far outweighs putting a new loan on your credit report. I hope that helped. It does affect it a little bit, but it's not very much.
Yeah, well worth the effort, in summary, to go ahead and go through the process of at least exploring an installment loan to pay off all that credit card debt. Okay, so I've got a question here from a member about the difference in store cards and big bank cards. Is there a difference when it comes to your score, or are they more or less treated the same?
There's not a difference when it comes to your credit score. The credit reports look at your combined revolving debt. So any company out there, whether it's a small store at the mall or one of the biggest ones out there, those all just get lumped together, all your credit limits, and that's how the credit bureaus factor your credit capacity. They add them all up together. And it's literally as easy as what percentage of that are you using? Now, there is a big difference sometimes with those cards for you, but not to the credit bureaus. And what I mean for you is some of those cards have annual fees that just go to nothing, just to pad the pockets of those companies. Another shameless plug, our card does not have an annual fee, but you need to look at those cards for yourself personally to see if they make sense for you. But if the question is, how do they affect your credit score differently? They don't. They all affect it the same.
Yes, well said, Brock. And there's another follow-up question regarding the difference in interest rates between a debt consolidation loan and a credit card. And I think I can take that one. You'll probably see in this day and age, the majority of retail store credit cards have interest rates north of 22%. With us, if you were to take out an unsecured debt consolidation loan, you're likely, depending on your credit score and your existing credit tier, going to save yourself anywhere between 5 and 10% in interest rate alone, compared to the cards that you've got. Big bank cards typically are a little bit lower in interest rate. A lot of them still are 18% or higher. And again, depending on your credit score, you can save a significant amount of money, as Brock showed you earlier, by taking out a consolidation loan and paying it off as quickly as you can. So good questions there. And another question about where's the best place to find a free copy of my credit report? And the answer is not Credit Karma, ladies and gentlemen. The best place to go is freecreditreport.com. It is a service provided by the 3 big credit reporting agencies, and it uses the FICO scoring model in most cases, which is most applicable to the scoring model that we use. Places like Credit Karma, Discover, and a few others use models that do not correlate to the reports and scores that we show our members.
And I'll piggyback off that just real quick, Jeff. When you have Credit Karma or any app like that, I think those are okay for you to use to get alerts about your credit. Like if anybody pulls your credit, you can typically see who you have loans with and things of that nature. You just have to be careful about what score it's reporting to you, because they don't use the FICO model that financial institutions use. They use a different model called the Vantage model, and their scores are a lot higher. Okay, so you could show that you have 1,000 credit score with Credit Karma, and that doesn't even exist in our world. The highest score you can have in our world is the 850. So the one thing you have to be careful about is if you see your score on apps like that or websites like that, whatever you're subscribed to, know that when you go in and apply for a loan, it's not going to be the same score. It's almost always going to be lower when you come to a bank or a credit union. And that's okay. We're operating on a totally different model than they are. But you can use those companies to get alerts if someone pulls your credit, just to save yourself any hassle or heartache in the long run. But what Jeff mentioned, where you can go get that copy of a free credit report, that's going to be the one that's going to be most similar to what we're using in the financial world when we're giving you your loans.
Yes, absolutely correct, Brock. Thank you for that. One more question, I think, before we've wrapped up what questions we have out there. Is using a home equity a good option for paying off credit card debt?
It's
If
a
so,
great,
why?
yes, it's a great option. Using a home equity loan might be the best option in paying off credit card debt. And the reason for that is you can get an installment loan. It doesn't have to be a home equity line of credit. You can get a home equity loan that has a term. The nice thing about home equity loans is you're going to get a lower interest rate than you would on a personal loan. So again, when we're talking about that interest that you're paying on a loan, you're going to be able to save on that. And number two is you can get more favorable terms. When you do a personal loan, whether it's through your credit union or another bank, typically they're not going to let you take it out for more than 6 or 7 years. They just aren't. If you have a substantial amount of credit card debt, it's hard sometimes to fit that into a 6 or 7 year term or lower. If you have a substantial amount of credit card debt, sometimes you need a little bit longer to pay that off. And a home equity loan gives you the option to sometimes take it up to 15 years. And like I said, everybody's situation is different. Bad stuff happens to good people all the time. You don't know what's going to happen to you. People lose their jobs. People send their kids to college. And sometimes when you do that, some people pay that stuff with credit cards. Some people pay medical emergencies with credit cards. So if you have tens of thousands of dollars of credit card debt, if we're talking $50,000, $60,000, $70,000, if you did that in a 5 or 6 year term, your payment's going to be high. But if you did it in a home equity loan, your payment could be considerably lower. So it is good as far as your rate and your term is concerned. It just kind of depends on what makes the most sense for your situation in particular.
Okay, once again, Brock, well done there. I do not see any more questions that we have not addressed at this point. So right now, as I mentioned, it looks like we've addressed the majority of the questions. If there are any additional questions, or if anyone has interest in discussing their individual credit situation with one of our credit professionals, make sure that you visit one of our 29 branch locations across the state. You can call 800-664-3828, or you can visit us online at michiganfirst.com. And lastly, on behalf of our 400 plus team members, I want to thank you all for participating and supporting Michigan First Credit Union. That's all for now. Once again, happy 2023 and enjoy the rest of your winter. Take care now.
Thanks, everybody.